Welcome to the deep dive. So if you've bought anything online lately, you've almost certainly seen that button right there at checkout.
That little invitation.
Yeah, the buy now, pay later option, Klarna, Afterpay, Payflex. I mean, these things have just exploded onto the scene, haven't they? Really changed online shopping in just a few years.
They really have. And today we're digging deep into BNPL. We've gone through a whole stack of sources, looking at how they work, the psychology behind them, the systemic risks that are starting to emerge, and how regulators globally are trying to catch up.
Right. And our goal here really is to get past that surface level appeal, the interest-free promise. We want to unpack the behavioral science these platforms are using and pinpoint the financial weak spots these systems create, systems that are growing incredibly fast.
So just to set the scene a bit, BNPL lets you split your payment, usually into 4, maybe 6 installments, often interest-free, paid over a short time. And its growth, well, it just took off with the e-commerce boom around the early 2020s.
And the scale is really key here. We're talking, by 2022, more than 1 in 5 U.S. consumers with a credit record had used BNPL. And what the sources really highlight is how high adoption is among subprime borrowers.
Yeah, that's a crucial point.
So while BNPL markets itself as this friendly, easier alternative to credit cards, the data we're seeing really points towards risks like overspending, partly because it hasn't been regulated like traditional credit.
Which brings us right to how it works day to day. That frictionless approval. It's designed for speed, right? Instant access based on soft credit checks or increasingly alternative data points.
Like Klarna's pay-in for, it feels effortless.
Exactly. And that ease isn't just about convenience. It's very much a deliberate design choice rooted in psychology.
Okay, so how exactly does that work? I mean, how does seeing 4 payments of $25 actually make us behave differently than seeing $100? What do the sources say?
It directly plays on a bias called mental accounting. When you break down the cost, it lessens the immediate feeling of financial pain, parting with the full amount. And studies show this significantly boosts the likelihood someone will actually buy.
Makes sense. But that same ease also creates a bigger problem, doesn't it?
It absolutely does. It's the perfect setup for what our sources call debt stacking or opaque accumulation.
Opaque accumulation. I like that term.
Because the approvals are so fast and they happen across different providers, you might get approved by Klarna, then Afterpay, then another one, almost at the same time. People very quickly lose sight of their total debt load across all these different apps. It's debt that often is invisible to other lenders or the main credit bureaus, allowing it to pile up dangerously.
And they push that interest-free angle really hard, which makes it sound so appealing. But what happens when you slip up? What are the actual costs?
Well, they can be pretty significant. While the core service might be interest-free, late fees can stack up fast, sometimes up to 25% of what you originally bought. And historically, because of the regulatory gaps, the kind of consumer protections you expect with credit cards, like clear processes for returns or disputing fraudulent charges, were often, well, patchy or just not there.
And speaking of financial strain, there's a really worrying trend emerging in the data, isn't there? It's not just about buying, say, a new pair of sneakers anymore.
No, that's the big red flag economists are waving now. We're seeing a major shift towards using BNPL for necessities. People are increasingly turning to it for everyday essentials, groceries, gas, even utility bills.
Wow. Using short-term installment credit for groceries, that really signals someone's facing serious cash flow issues.
It does.
If you connect the dots, it looks like BNPL is shifting from maybe a convenient budgeting tool for some to potentially a risky lifeline for people already struggling financially.
Exactly right. And there's research showing that new BNPL users often ended up paying more in bank overdraft fees and credit card interest compared to similar people who didn't use BNPL. So it creates this secondary financial drag.
Okay, that leads us perfectly into the whole behavioral angle, the gamification of debt. This is where things get really interesting, how these platforms are designed to keep users coming back.
Oh, the psychological engineering here is, let's say, sophisticated and very intentional. BNPL apps often look and feel like social media or games. They use points, reward systems, little badges, progress bars for making payments.
So it's not just about making one purchase easier.
Not at all. The aim is to build habits, encourage regular, even compulsive use. It's about making debt feel less serious, almost trivial.
Can you give us a concrete example of this kind of gamification?
Sure. Afterpay's Pulse Rewards program is a textbook case.
Hmm.
If you consistently pay on time, you unlock perks. Things like being able to push back your first payment on the next purchase or getting late fees waived. It's designed to incentivize using it again and again.
Making it sticky.
Very sticky. Klarna does similar things, using personalized push notifications, reminders about anniversaries for past purchases, or highlighting sales at your favorite stores, all nudging you towards more spending.
So if they're using things like random rewards, streaks, these game-like incentives, aren't these the exact same psychological tricks used in gambling? Does that mean for some users, BNPL could function like a form of financially leveraged gambling?
It certainly leverages some of the same cognitive mechanisms.
Yeah.
The sources talk explicitly about variable ratio rewards, that unpredictable element that keeps you hooked, similar to slot machines. It taps into the brain's reward pathways, significantly increasing the risk of overuse compared to, say, a standard loan.
And combine that with what you said earlier about mental accounting.
Yes, exploiting loss aversion by splitting the payment, making it feel less painful. You put these together, and you have a system that can effectively bypass careful, rational budgeting.
And isn't there also something about decision fatigue at the point of sale?
Absolutely. Think about online checkout. You've already made a bunch of choices about the product, size, color. By the time you get to payment, your mental energy might be low. That simple, frictionless pay later button becomes the path of least resistance.
An easy default.
Exactly. And this normalization of constantly using credit raises real ethical questions, particularly when these services disproportionately attract younger users, Gen Z, millennials, often those with limited credit history, what they call thin-file consumers.
Okay, let's shift gears slightly. We've talked about the psychology, but what about the other price we pay? Our data. What are the privacy and security risks tied to these models? They seem incredibly data hungry.
That's potentially one of the biggest long-term concerns. These platforms collect a vast amount of data, not just your purchase history, device information, your location, and critically behavioral data.
Behavioral data, like what?
Like how long you pause on a product page, or hover over the buy button before clicking, or even hesitation before choosing the BNPL option itself. This feeds into their risk models, sure, but also heavily into targeted marketing and personalization.
So the platform isn't just facilitating payments, it's building this incredibly detailed profile of your spending habits and even your decision-making process. Essentially, a digital surveillance engine driving sales.
That's precisely the concern raised by regulators like the Consumer Financial Protection Bureau, the CFPB. They specifically pointed out that some BNPL business models seem heavily reliant on this kind of digital surveillance, using what they called extraordinarily detailed purchase data to create hyper-targeted ads and basically funnel you into their own closed-loop shopping apps.
A walled garden where they track everything, and is this data kept locked down? Or is it shared?
Well, that's another issue. One analysis found Afterpay, for example, collected around 20 different types of data and shared 17 of those with third parties. That included things like credit score info and even user location data. And naturally, collecting all this sensitive data significantly increases the potential damage if there's a security breach. The attack surface just gets wider.
Have we seen actual security failures happen with these platforms?
Yes, there have been several notable incidents. Back in 2021, Klarna had a technical glitch, a software misconfiguration, that temporarily exposed some user account details to other users. Block, the company that owns Afterpay, reported a breach affecting about 8.2 million users.
Okay.
And it's not just the BNPL firms themselves. Because they often partner with banks to actually issue the loans, those connections create more vulnerability points. We saw that in 2024 when a firm's banking partner, Evolve Bank, was involved in a data breach that reportedly exposed customer data onto the dark web, leading to class action lawsuits.
Right, that ripple effect, all of it, the debt accumulation, the data risks, really highlights why regulators are scrambling to catch up, doesn't it? Where do things stand globally on that front?
It's definitely a global effort now. Australia really led the way, bringing in specific BNPL rules under their Credit Act in 2023, requiring companies to be licensed and follow stricter conduct rules starting in 2025. The UK is also moving forward, planning to bring BNPL under the Financial Conduct Authority's oversight from 2026, which will include mandatory affordability checks.
And here in the U.S., the CFPB seems to be trying to align BNPL with existing credit card rules.
That seems to be the main thrust, yes. After a major inquiry into the industry, the CFPB issued what's called an interpretive rule in 2024. It essentially says that BNPL lenders need to provide consumers with the same kinds of protections as credit card companies when it comes to things like handling disputes and processing refunds. The goal is parity on those core safeguards.
Which suggests the regulators are seeing real evidence of consumer harm, not just potential problems. What are some of the documented impacts? You mentioned the debt stacking.
Right. The CFPB has been quite blunt, warning that the current BNPL model, relying on those behavioral nudges, late fees, monetizing data, carries echoes of the problems seen historically with payday loans and subprime credit. And the real-world stories are concerning. You mentioned that New York Times piece where individuals describe racking up debt, sometimes over $10,000, spread across multiple BNPL accounts.
$10,000 from what's supposed to be small, short-term financing, that's a deep hole.
It really is the definition of a debt vortex. And we see similar patterns internationally. For example, there were warnings coming out of South Africa about providers giving out relatively large credit limits, like up to R30,000, almost instantly to consumers with little or no credit history. This led to rapid over-indebtedness and, in some cases, raised the specter of asset seizure if payments weren't made very much mirroring predatory lending practices.
Okay, so given all these risks, and while we wait for regulations to fully kick in everywhere, what can people do right now to protect themselves if they use BNPL?
The sources suggest some clear, practical steps. For consumers, the absolute key is awareness and tracking. You really need to keep tabs on all your BNPL commitments, maybe using a budgeting app that can pull together all those different installment plans so you see the total picture. And critically, read the terms and conditions, especially the parts about late fees, how returns are handled, and the dispute process, because these can vary a lot between providers. Checking your credit report periodically is also wise, even though not all BNPL currently reports to bureaus.
And from a policy perspective, what needs to happen systemically?
Two main things stand out from the regulatory discussions. First, mandating clear, standardized disclosures showing the total cost of the item if paid via BNPL, including potential fees and a very clear payment schedule. Second, and this is crucial, requiring BNPL providers to report loan uptake and repayment behavior to the major credit bureaus. Without that, lenders simply don't have a complete picture of someone's overall debt load when assessing risk for other credit, like mortgages or car loans.
So wrapping this up, our deep dive really shows that while BNPL offers genuine convenience and flexibility, its fundamental design isn't neutral. It seems intentionally built, using sophisticated psychology and extensive data harvesting to encourage repeat usage and debt accumulation, often in ways that aren't immediately obvious to the user.
Absolutely, it's a powerful tool, no doubt. But without strong ethical guidelines and robust regulation, it's currently operating much like a high-risk credit engine optimized for rapid, frequent borrowing, sometimes masking underlying financial distress.
And consider this. The global BNPL market is forecast to handle over 5% of all global e-commerce transactions by 2025. That's huge. Which leaves us with a pretty critical question for you, the listener. Can these incredibly fast-growing, data-driven services truly balance innovation and financial inclusion, especially for those with limited credit access with ethical lending and solid consumer protection? Or is their current business model maybe fundamentally dependent on the very financial vulnerability that regulators are now trying so hard to curb? Something to definitely mull over the next time that easy installment option pops up at checkout.